Let's talk tax deductions for investment properties in Western Australia and discuss some of the most common mistakes we've seen landlords make over the years. Hello, it's Vera from Stage Property, and let's begin with the golden rule of taxation. Only claim what's directly linked to your rental income. That's right, every expense you deduct should only be a cost that comes from earning rent from your property. Never forget that the tax office doesn't have a sense of humor. They frown on claims that are not legal and relevant, and unless you're keen to spend a fortune on legal bills fighting them over something inappropriate you try to claim, then it's a losing situation for you to be in. Yes, I know this is an obvious mistake, but people keep making it, so it's possibly not as obvious as people think. Next, let's talk paperwork. Keeping meticulous records is a must. Save every receipt, invoice, and bank statement related to your property. This practice is not just good for organization, it's also essential for accurate claims. Don't hesitate to bring a qualified quantity surveyor into the picture if needed. By the way, if you've never heard about quantity surveyors before, they specialize in preparing tax depreciation schedules for landlords, which help you claim wear and tear of your investment property against your taxable income. Much the same way in which a business owner can claim depreciation on a company vehicle or equipment, investors can also claim depreciation on their investment property. Quantity surveyors are qualified to assess the depreciation value of both the building structure, termed capital works allowance, and the removable assets within the property, more commonly known as plant and equipment, such as your stove, carpets, and so forth. Moving on, timing is everything with deductions. You have to claim them in the right financial year. Some expenses are immediate, while others stretch over time. Knowing the difference is key. Here's a tip you should only avoid at your own peril: seek professional advice. Tax laws are complex and always evolving. A tax professional can give you tailored advice, ensuring you make the most out of your deductions. Another thing to be careful of is to avoid the mix-up of personal and investment expenses. Only expenses solely for your investment property can be claimed. Personal costs are a no-go. Stay alert to the ATO's focus areas. They're keeping a close eye on investment property deductions, so understanding and following the rules is more important than ever to avoid mistakes. And finally, if you're thinking of selling, be mindful of the tax implications, including capital gains tax and associated selling costs. It's an important part of your tax strategy. By keeping these guidelines in mind, you're setting yourself up for a smoother, more efficient tax return for your property investments in Western Australia. In closing, if you've got questions about this topic, feel free to call the team at Stage Property for a confidential chat. And if you're looking for a highly experienced property manager to help make your investment journey smoother and more profitable, you can ring us on 08 9325 9888. Okay, this is Vera Jan signing off. Thanks for watching, and if you'd like to receive more property investment videos, like and follow Stage Property on social media.